All right, so in this section, we're going to explore what the Federal Reserve is, how they're structured, and what policy tools they actually use in practice. So we described in the previous lecture that in the United States, banks keep less than 100% of their deposits on hand as reserves. Typically, banks loan out about 90% of the deposits they have, or they invest that money in other assets in order to earn a profit. This is called a fractional reserve banking system, where only a portion of the reserves are kept on hand, and the rest, are invested so the bank can profit. And pretty much all countries have a fractional reserve banking system. This normally is not a problem that banks don't have all the cash on hand because people rarely withdraw all the money they have from their account. Sometimes, in extremely stressful situations, depositors can lose confidence in a bank. If they question the value of the bank's underlying assets, so if they think that the bank's going to lose money on those assets, so they don't have enough money to end up covering all the deposits. So when they have this lack of confidence, what you end up seeing is what's called a bank run. So a lot of depositors simultaneously go and try to withdraw their money from the bank. Again, that's seen towards the beginning of It's a Wonderful Life, is a perfect example of a bank run. Now, if many banks experience a run at the same time, we call that a banking panic. That's when the bank runs are widespread across the economy. So one bank may be able to handle a bank run by borrowing from other banks, but if a lot of banks are experiencing this simultaneously in a banking panic, it's very difficult for a bank to find someone who's actually going to be willing to lend to them, so the banking system is in trouble. So a central bank like the Federal Reserve can help stop a banking panic by acting as what's called a lender of last resort. When a bank that's experiencing a bank run can't find other banks that are willing and able to lend to it, they can go to the Federal Reserve, they can go to a central bank who will be willing to lend to them in order to make sure that the financial system keeps functioning properly. So this figure shows how a banking panic can take place. So first, there's bad news. For some reason, there's something that happens that makes depositors question the value of the bank's underlying assets. Maybe there's a sharp drop in the stock market. Maybe a lot of the bank's loans are likely to be unpaid because the firms are loaning to are going bankrupt. Something makes depositors question whether a bank is going to be able to cover all the deposits they have. So what do? Being rational individuals, they rush to be the first person to make sure they can get their money out of the bank. Knowing that there's only some money on hand, they know that they want to be first in line so they can be guaranteed to get that money back. The bank's going to pay these depositors until their money runs out. And again, they normally have about 10% on hand, maybe a little bit more. So it's not going to take very long. Now, sometimes this spreads. If a lot of banks all suffer from that bad news, there's banking runs going on simultaneously, you end up with what's called contagion. So other banks are now experiencing a run at the same time. This can spread not only from unhealthy banks, but to healthy banks, as depositors seeing that other banks are experiencing runs think, well, this could happen to my bank next, so I have to go pull out my money. So even healthy banks are getting pulled in to this run. Now, banks react by selling assets and reducing their loans to households and firms so that they have enough money to cover the depositors. The problem is, with selling assets in these stressful situations, is that they end up having to sell these assets at a lower value than normal. So this drives down the price of these assets, and it makes the banks makes it more difficult for them to cover their deposits because they're selling these assets at a lower value than before. This also is more bad news that encourages more banking runs. Finally, this has an effect on the broader economy. We'll see output fall, employment fall, as firms are not able to borrow as much from banks. We'll see asset prices decline as these fire sales continue, and banks are selling assets as quickly as they can for whatever price they can get, just so they can cover the depositors who are trying to pull out their money. One thing that central banks do is serve as lender of last resort, so they can step in and promise to lend to these banks so they'll be able to cover their deposits in the short run. So that way they don't have to sell these assets or reduce their loans, knowing that in the long run these banks will be healthy enough that they'll be able to pay back the loan to the Federal Reserve. So this assurance of having a lender of last resort can break the negative feedback loop that we see going on in the figure on the right. 19th century and early 20th century, the United States experienced a series of banking panics. Uh, the Panic of 1907 was particularly difficult to deal with. Um, Bank lending stopped across the country. There was a contagion where there was a run on a few banks that led to more and more banks being taken down, including healthy banks. And J.P. Morgan himself ended up serving as lender of last resort, propping up the financial system by offering loans to these banks because of the amount of money he had at his disposal. Seeing that, politicians realized the importance of having some sort of lender of last resort. Up until this point, the United States did not have a central bank, unlike countries like England or Germany, which had central banks before the United States. So in 1914, the Federal Reserve System was created. Basically what the Fed does, how they function, is they make loans to banks, and these are called discount loans. And the interest rate that's charged on the discount loans are called the discount rate. And this was the Federal Reserve's main policy tool when they were first created. This and reserve requirements. Currently, reserve requirements are 10%. In the past, it would be adjusted by the Federal Reserve based on the current macroeconomic conditions. During the Great Depression in the 1930s, a lot of banks were hit by bank runs simultaneously, and these bank runs continued for years. It wasn't just in a short period of time, like normal banking panics. So, because they were afraid of encouraging bad banking practices, this so-called moral hazard where you bail someone out when they do something wrong, so they don't have any negative repercussions of these actions, the Fed refused to make discount loans to many banks, and over 5,000 banks failed, which was catastrophic for the economy at the time. A lot of economists are very critical of how the Federal Reserve performed in the lead up to and during the Great Depression. This is one of the critiques that a lot of economists agree on, that they should have extended these discount loans to banks. As a result of the Great Depression and the runs on banks that continued for a long time, Congress established the Federal Deposit Insurance Commission, or Corporation, or the FDIC. So a lot of your bank accounts, banks will advertise that they are, FDIC protected. The FDIC does is insure deposits in banks up to a limit, and that current limit is $250,000. So if the bank is unable to fulfill their obligations, they're unable to give you the money from your bank account, the FDIC will give you that money up to $250,000. This guarantee is in place to help limit banking panics. The basic idea is if people know that they can get their money from the FDIC later, or I guess right now, there's no reason to run on the bank and pull your money out because they know they're going to get that money no matter what, no matter who it's from. So, just removes this incentive for people to actually run on the banks. But bank runs are still possible. During the financial crisis, a few banks experienced runs from large depositors whose deposits exceeded the FDIC limit. So those people knew they only were protected up to $250,000, but they had a lot more money than that deposited in those banks. So they would pull out money over the $250,000 limit. So here's a map showing the different districts of the Federal Reserve. Congress divided the country into 12 different Federal Reserve districts, and each district has banks, as a Federal Reserve bank that oversees banking, makes loans, serves as a clearinghouse for checks, provides all these different functions within each district. The Federal Reserve is sometimes called the creature from Jekyll Island. Part of it is because of its odd structure. American government is designed based on federalism. Americans, at least early Americans, loved the idea of federalism, and this was included in the structure of the Federal Reserve. And some of that was because Americans were just inherently distrustful of banks and central banks as well. Most countries just have one overarching central bank in charge of the entire country. We've split it up into 12 different districts, and you see there's a lot of districts run through portions of states. Some of these were done for political reasons. For instance, Missouri. Senators from Missouri were very skeptical of the Federal Reserve, so what they did is ended up having 2 Federal Reserve banks, and that was used to sway the Missouri senators to vote in favor of the Federal Reserve Act. The real power of the Federal Reserve to act as lender of last resort, or for a lot of the monetary policy that we're going to talk about in this chapter, lies in Washington, D.C. with the Federal Reserve Board of Governors. In 2016, when this textbook was written, the chair of the Board of Governors was Janet Yellen. who had the pleasure of getting to speak twice while she was chair. The current chair of the Board of Governors is Jerome Powell, and he's been in place since 2017. The actual power of monetary policy, the decision making, and then the order to carry it out is held by the Federal Open Market Committee. Now, the FOMC, they meet 8 times per year to decide on monetary policy. Now, there's 12 voting members of the FOMC. 7 of them are members of the Federal Reserve's Board of Governors. So the chair, the vice chair, and then 5 other Board of Governors members. 1 member is the Federal Reserve Bank of New York president. They always sit on the FOMC because it's the New York Fed that actually enacts monetary policy, which we'll discuss a little bit more later. Then there's 4 presidents of the other 11 Federal Reserve banks. These presidents serve on a 1-year rotating basis as voting members of the FOMC. In other years, when they're not voting members of the FOMC, they still sit in and are able to discuss in meetings, but they're not actually voting on the Fed's monetary policy. So what they do is decide the action of the Federal Reserve. So basically when they want to manage the money supply and interest rates, consistent with their macroeconomic policy objectives. Their macroeconomic policy objectives are called their dual mandate. They're given by Congress in the Humphrey-Hawkins Act of 1977. The dual mandate being full employment and price stability. So the goal is to keep inflation low and stable, and is to keep unemployment as low as possible. Remember from the previous chapter on unemployment, there's always going to be some employment or some unemployment in the economy. There's always some structural and frictional unemployment that's going to be present. The goal is full employment is to get rid of all cyclical unemployment. The Federal Reserve also has some other minor policy objectives, which is steady growth, to smooth the business cycle, and also broad financial market, to prevent financial market volatility. So the Federal Reserve's main tool for managing the money supply is currently open market operations. Now, open market operations were discovered by the Federal Reserve in the aftermath of the Great Depression by accident. They had a portfolio of government treasuries, and they went to sell some of them because they wanted to just get some cash for those assets. They found out that they actually moved interest rates in the market, and over time they began using this as their main monetary policy tool. Now, when the federal government spends more than they collect in taxes and in other revenue, it runs a budget deficit. So in order to fund this deficit, the U.S. Treasury is going to borrow. So what they do is they sell bills, notes, and bonds. So open market operations, what the Federal Reserve does is buy and sell these treasury securities in order to help influence the money supply and interest rates. Typically, the Federal Reserve buys treasury bills. Treasury bills have very short maturities, usually 1 year or less. Sometimes during like the financial crisis or during a period in the 1960s, the Federal Reserve will buy longer term assets. So they'll buy treasury notes that are like 2 to 10 years. So in order to increase the money supply, the FOMC directs the trading desk at the New York Fed to buy treasury securities. So treasury bills, notes, and bonds. Although, like I mentioned, typically these are going to be treasury bills. Now, the reason this increases the money supply is because when the Federal Reserve buys these assets from banks, they take the asset from the bank and they give them money. The banks take that money, they turn around and they lend it out to consumers and to firms. So through that, it's going to increase the money supply. And like we talked about earlier with that initial deposit of $1,000 leading to $10,000 of an increase in the money supply, we're going to see the same thing happen here, only instead of someone depositing money in a bank, it's the Federal Reserve depositing money in a bank, basically. Now, if the Fed wants to decrease the money supply, they're going to do the exact opposite. They're going to sell its securities. So when they sell securities to banks, they give the banks the security, so in this case, the treasury bill, and the bank gives them money. So this removes money from the money supply, so it's going to decrease bank lending. Now, these open market operations can occur very quickly, especially now with the internet and with computers. very quick to enact these. They decide, to do it at 9 a.m. and by 9:10 in the morning, all the open market operations are settled for the day. And they're very easily reversible. And the Federal Reserve does engage in a slightly different version of open market operations. They sell slightly different assets that we don't need to go into detail of, but they do this to fine tune their open market operation purchases to make sure that there's reaching their interest rate target. Walk through an example of open market operations so we can see what's going on here. So let's say the Fed engages in an open market operations purchase of $10 million. So we can illustrate this using the T accounts that we used in the previous lecture. So one for the Federal Reserve and one for the banking system as a whole. So the banking system's T account is going to be based on the banking system's balance sheet. Again, the balance sheet is just going to add together the assets and the liabilities of all the commercial banks in the United States. So as a result of this open market purchase, the banking system's holdings of treasury bills is going to fall by 10 million, and its reserves are going to increase by 10 million. The Federal Reserve made this purchase, so they're giving the banking system cash, and they're receiving assets from the banking system. So the Federal Reserve, their liabilities are going to increase by 10 million because the reserves of the banking system are a liability for the Federal Reserve. These reserves are often held at the Federal Reserve, so they have that money. They're going to have to pay that back when the banks try to withdraw those reserves. And the number of treasury bills that the Federal Reserve holds as assets are going to increase by 10 million. The Federal Reserve is also responsible for putting the paper currency of the United States into circulation. The currency is printed by the U.S. Treasury. If you look at your dollar bills, they're signed by the Secretary of the U.S. Treasury, but it's the Federal Reserve that actually distributes those to banks. And if you look at your $1 bill, on the left side, the little seal, it will tell you what Federal Reserve region that bill comes from. So the main way the Fed increases the money supply is not by printing more currency, but it's by buying these treasury securities. They buy these treasury securities from the banking system, and they give the banking system these dollars. And from there, the banks lend it out to consumers and lend it out to firms. Now, the Federal Reserve has two other tools for managing the money supply. The first is the discount policy. So they use the discount rate. Remember, the discount lending to banks in their role as lender of last resort. So the discount rate is the interest rate paid on the money that banks borrow directly from the Federal Reserve. Banks are constantly lending with each other throughout the day in order to meet the Federal Reserve's reserve requirements. So oftentimes banks, they're required at the end of the day to have 10% on hand. But oftentimes they'll be below that. A lot of banks will be at 8, 9% because more people happen to take out money from their accounts that day than they expected. So what those banks have to do is lend or borrow from one another, and some other bank has to be willing to lend to them. Typically, banks have no problem lending with each other because these are just overnight loans, and they're paid back the next morning to start the day. Sometimes during a financial crisis or when there's a bank run, these banks don't have confidence in other banks, so they're going to be unwilling to lend to them overnight. In that case, those banks go to the Federal Reserve and they get a discount loan. Now, this is going to be a higher interest rate than they would get from borrowing from other banks because banks consider them more of a risk. So when the Federal Reserve lowers the discount rate, the Fed encourages banks to borrow, hence lend out money, increasing the money supply. When they raise the discount rate, they're going to discourage banks from borrowing and from lending out money. So you're going to have less money. It's going to decrease the money supply. And the final tool of the Federal Reserve is reserve requirements. So the Fed can alter the reserve requirement ratio. Instead of 10%, they could say it's only 8%, or they could say it's 12%. A decrease, so for instance from 10% to 8%, would result in more loans being made because banks have to keep less money on hand. So that's going to increase the money supply. An increase in the reserve requirement, say going from 10% to 12%, is going to result in fewer loans being made because banks have to keep more money on hand. So it's going to decrease the money supply. What we've been talking about so far are commercial banks. So basically how they function is they accept funds as deposits and they make loans to borrowers or invest in assets in order to earn a profit. But in the last 20 years, 30 years, even 40 years, we've had two developments in the financial system that have kind of changed as we moved away from your typical simple commercial banks. The first is that banks have begun to resell many of their loans rather than keeping them on their books until they're paid off. So what they do is they sell these as assets that other banks are able to invest in so they can get a money stream coming in. And the second development is financial firms other than commercial banks have become sources of credit to businesses. So we have some, firms other than your very typical commercial bank that's involved in lending. So we've expanded the different types of lenders. So how did the securitization come to these commercial banks? It used to be quite simple. Remember, security is a financial asset, like a stock or a bond, that can be bought and sold in the financial market. Traditionally, when banks made loans, like a residential mortgage loan, they would keep the loan and collect the payments until the loan was paid off. I remember when I was in college talking about this, and my mom said it was odd that the last 5-10 years of their mortgage, every couple months it seemed like the bank they were actually paying the mortgage to was changing. And that's because my parents' mortgage was securitized and sold from the initial bank to other banks. In the 1970s, thanks to the federal government's attempts to increase home lending in the state of California, a secondary market developed for securitized loans. So banks could take these loans, package them together, and then trade them, sell them to other banks or to institutional investors. So they could be traded like we do stocks and bonds. They were just turned into another type of asset. Only instead of being backed by, the profit of a company, they're backed by mortgage payments coming in every month. So that's what, if you remember during the financial crisis, people talking about mortgage-backed securities, that's basically what it is you buy an asset, which is just a bunch of people paying their mortgage each month. So your payments are payments of those people paying off their mortgages. All right, so now let's walk through the process of securitization of these types of assets like home loans. So first, the banks grant loans to households that they use to purchase these homes. From there, financial institutions take a bunch of those loans and bundle them together into a security. From there, investors can now buy shares of that. They can buy portions of those bundled securities. So every time someone pays off their mortgage, that money goes through the initial financial institution to those investors. So banks collect those payments from households, and we see this in the second part of the diagram. The money goes to the financial institutions, to the banks, who get a fee for processing those payments. And then the banks send those payments to the investors, and that's where their income stream comes from. Now, when everyone's paying their mortgages, this works great. It's fantastic for investors. But when we see a lot of defaults, that's where the problem comes. And that's what we saw during the financial crisis. Since the 1990s and into the 2000s, there was an increasing importance of non-bank financial firms to the financial system. So rather than the typical commercial banks that we've talked about before, investment banks like Morgan Stanley, for instance, began to become a more important player in the financial system. So for these investment banks, rather than being like a normal commercial bank, accepting deposits and making loans directly to households, they operate differently. So what investment banks do is provide advice to firms issuing stocks and bonds, or that are considering mergers or acquisitions with other companies. In the late 1990s, what we saw was investment banks began expanding their purchasing of mortgages. They bundled those together into those mortgage-backed securities and then sold them to investors. Mortgage-backed securities for a time were extremely popular because they often paid high interest rates and they were considered extremely safe. In fact, international regulation listed mortgage-backed securities as one of the safest assets. So banks were more than happy to get a high return on these, what they thought were incredibly safe assets. Next in the shadow banking system is money market mutual funds. Money market mutual funds sell shares to investors who then turn around and use that money to buy short-term securities like treasury bills and commercial paper. So commercial paper is short-term borrowing for firms, and treasury bills are short-term funding for the federal government. So many corporations that previously met their needs for like short-term funding from borrowing from banks instead began to sell this commercial paper to money market mutual funds. So it's just a different source of funding than we saw before. And last is hedge funds. Hedge funds are funds that raise money from wealthy investors, and they make very sophisticated or non-standard investments. Regulations prevent people from below a certain net wealth from even investing in hedge funds because they're considered so risky. Basically, what rich people do with hedge funds is they may have a very complicated investment. So what they'll invest in some very odd, considered risky asset or some risky type of asset. That's the opposite of what their major investment is. So what the hedge fund does is it hedges against extreme risk. So if a company goes bankrupt or if the stock prices go down too far and what their main investment is, the hedge fund is in the opposite direction, so it'll help balance that out. So during the financial crisis from 2007 to 2009, the shadow banking system played a major role in causing and making that crisis deeper. Now, why there was a difference here and why the shadow banking system matters is that these firms were less regulated by the government, and they weren't FDIC insured because they weren't commercial banks. These firms also became highly leveraged, so they relied more and more heavily on borrowed money. So they wouldn't just invest the money they had, they would borrow money at a lower interest rate and then invest it to try to earn a higher return. When things are doing good, when the economy is performing well, that's a good way to make money. But when there's a downturn, it's a very easy way to lose a lot of money in a very short amount of time. And that's what we saw happen. So beginning in 2007, firms in the shadow banking system were quite vulnerable to runs. Because they were heavily invested in mortgage-backed securities, as people began to default on their mortgages, they had more and more problems. They had lower returns because of the people that were defaulting on those mortgages. By the spring of 2008, the investment bank Bear Stearns was able to avoid bankruptcy only by being purchased by J.P. Morgan Chase. And even with that, the federal government had to make some guarantees and take some of the what they called toxic assets off of the balance sheet so that J.P. Morgan Chase would be willing to even purchase Bear Stearns. In fall of 2008, the investment bank Lehman Brothers was forced to declare bankruptcy after almost all their clients pulled their money out. So what exactly happened? Well, as housing prices began to fall, again, a number of borrowers defaulted on their mortgages. And this caused the mortgage-backed securities to lose value because there's less money actually being paid into it. So they're not able to cover all the investors that invested in those mortgage-backed securities. Financial firms that had invested in those securities, so both commercial banks and those in the shadow banking system, suffered pretty big losses. The more leveraged the firm was, the larger the losses. So like Bear Stearns and Lehman Brothers, who were highly leveraged at the time, again, they used a lot of borrowed money to invest, were in serious trouble. So even though we have deposit insurance to help commercial banks avoid runs for depositors, trying to pull their money out, investment banks and these other financial firms didn't have this protection. So at the time, they were borrowing very short term, and they were investing the funds more long term, like mortgage-backed securities. But as investors saw how these investment banks were struggling, as the value of mortgage-backed securities were falling, they were less willing to lend to them. So what these investment banks had to do is sell those assets that they had in order to raise cash in the short term. Well, as they sell those securities to raise cash, the prices of those securities are not only falling, but they're going to continue to fall. So those firms are going to lose more and more money. So the failure of Lehman Brothers echoed through the financial system, and it threatened to topple it. The process of securitization ground to a halt. So banks were unable to sell their loans, so they stopped making as many loans. So we had this rippling effect throughout the economy. The resulting credit crunch worsened the recession, and banks ceased lending to each other, and they seriously curtailed lending to consumers to buy houses or to firms. Beginning in 2008, in the fall, the Federal Reserve took some pretty vigorous action under what was called the Troubled Asset Relief Program, or the TARP program. So what they did in this was provide funds to banks in exchange for stock to make sure that banks had enough cash on hand in order to cover their expenses, and that any depositors or any investors that wanted their money back were able to get their money back without those institutions needing to sell their assets. Also offered discount loans to previously ineligible investment banks. So these shadow banking institutions that previously did not have access to this, to the easy Fed loans, were able to get it, again, to keep them afloat. And the Fed began buying commercial paper, so the short-term funding that corporations used for the first time since the 1930s. Eventually, these actions helped stabilize the financial system and saved it from, the brink of collapse. Economists and policymakers are still debating the actual wisdom, whether they should have been done differently, done earlier, all these different things. But in general, there's agreement that what they did was a positive step that did somehow help the financial system. And now we're going to end with section 14.5, the quantity theory of money. So beginning in the 16th century, the Spanish colonies were producing quite a bit of gold and silver, which at the time was used for currency. So Spain sent home gold and silver from Mexico and Peru and back to be minted and used as coins in the European continent. What this did was drastically increase the money supply. So for the Spanish nobility and for the monarchs, it was great for them that they got this money, were able to spend it into circulation. But over time, all it ended up doing was increasing the prices in Europe. So the prices of all these goods and services increased as the money supply increased. So at this time, even way back when, people were able to make the connection between the amount of money in circulation and the price level. But we're going to formalize this and understand what actually is going on here in this section. So about 100 years ago, the economist Irving Fisher formalized the relationship between money and prices in the quantity equation. So the quantity equation is M times V equals P times Y. Basically what this equation states is that the money supply, M, times the velocity of money, or the average number of times each dollar in the money supply is used to purchase a good or service, or how often it changes hands, equals the price level multiplied by the real output. We can rewrite that equation to solve for velocity. When we do that, velocity equals the price level times real output divided by the money supply. Using that equation, we can actually calculate the velocity of money, or how often each dollar bill changes hands. So if we measure the money supply with M1, the price level with the GDP deflator, and the real output with real GDP, we can get the following value for velocity. So if we use the GDP deflator of 1.09, the GDP of 16 trillion, and the money supply of $2.8 trillion, the M1, that will equal 6.2. So what does this velocity tell us? It tells us that during each year, each dollar bill is spent on average 6.2 times. And because velocity is defined to be equal to P times Y divided by M, we know that the quantity equation must always hold true. The left side of the equation must be equal to the right side. So we can use this quantity theory of money to show the relationship between changes in the money supply and changes in the price level, or inflation. So we can get at what we're trying, to understand with this relationship between inflation and the money supply. So to see this more clearly, we can use this mathematical rule that states that an equation in which variables are multiplied together is equal to an equation in which the growth rates of these variables are added together. So we can change the M times V equals P times Y into the growth rate of the money supply plus the growth rate in the velocity of money equals the growth rate in the price level, or the inflation rate, and the growth rate of real output. So we can then rearrange this to make inflation the left-hand side variable and assume that the velocity of money is constant over this time. Then we get the inflation rate equals the growth rate of the money supply minus the growth rate of real output. So if this holds true, this equation provides us the following three predictions. The first is that if the money supply grows at a faster rate than real GDP, we're going to experience inflation. The price level is going to increase. Two, if the money supply grows at a slower rate than real GDP, there will be deflation. The price level will decrease. And three, if the money supply grows at the same rate as real GDP, the price level will be stable over time, and we will experience neither inflation or deflation. Now, it turns out Irving Fisher's assumption that the velocity of money is constant is wrong. From year to year, we see significant fluctuations in velocity. So because of that, predictions of inflation based on the quantity theory of money don't hold every single year. But most economists do agree that the quantity theory of money provides useful insight into the long-run relationship between the money supply and inflation. So in the long run, inflation results from the money supply growing at a faster rate than real GDP. Milton Friedman once said the quote that inflation is always and everywhere a monetary phenomenon. That's exactly what he was referencing, was this rule. So the accuracy of the quantity theory of money depends on whether the key assumption that velocity is constant is correct. If velocity is not constant, which it isn't in the short run, there may not be a tight link between increases in the money supply and increases in the price level. So for example, an increase in the quantity of money might be offset by a decline in velocity, which will leave the price level unaffected. So again, because the velocity can move erratically in the short run, we would not expect the quantity equation to provide good forecasts of inflation in the short run. But over the long run, like I said, there's a strong link between changes in the money supply and changes in inflation. So the figure on the right shows the relationship in the United States over time in between the growth in M2 as a measure of money supply and the inflation rate. So there's not an exact relationship between the growth of M2 and the inflation rate, but there's a clear positive upward trend. When we look at countries around the world and compare them, we see pretty much the same thing. We don't see a perfect relationship, but we do see a positive relationship between M1, money growth, and the inflation rate. So it's not a stretch to say that inflation is always and everywhere a monetary phenomenon, that the money supply is very important in affecting the inflation rate. So using the quantity theory of money, we can understand the reason for very high rates of inflation. Why do some places and sometimes have hyperinflation or extremely high rates of inflation? Basically, hyperinflation is caused by central banks increasing the money supply at a rate far in excess of the growth rate in real GDP. So often this happens because governments want to spend more money than they raise through taxes. So they force the central bank to buy government bonds and use that to increase the money supply. So in Zimbabwe recently, the inflation rate became high enough that people stopped using the paper currency because they were experiencing this hyperinflation. And during the 2000s, prices increased on average of 7,500% per year. So these are insanely high increases in the price level. So to put that in perspective, a can of soda that cost $1 this year would cost $75 the next year and $5,600 the year after that. So these are substantial changes in the price level. Hyperinflation tends to be associated with slow growth, the textbook says, which is a bit of an understatement. It's usually accompanied by a severe recession or depression, and it completely wrecks an economy until they're able to establish a stable currency, typically by removing the old currency from circulation and creating a new currency, something that's tied to a stable currency. So often they'll tie it to the US dollar in order to provide enough confidence to the market that people know that they're not going to just, massively increase the money supply again. They can't because they're tied to another asset like the US dollar. Another historical connection for hyperinflation, another example, is the German hyperinflation in the Weimar Republic in the early 1920s. So after World War I, the German government was forced to pay reparations to the Allies for the cost of, everything that happened in World War I, and destruction it posed across Europe, and the number of lives that were lost. They were extremely high, and after some period of time, Germany was unable to cover both its regular spending and the reparations they had to pay. So the German government began selling bonds to its central bank, or the Riksbank. This had a pretty easy to predict effect. They massively increased the currency in circulation, so it rose from 115 million Reichsmarks in January 1922 to 1.3 billion Reichsmarks in January of 23, and 497 billion Reichsmarks by the end of 1923. And just as the quantity theory money would predict, the result was an insanely high rate of inflation. So the price index in Germany stood at 100 in 1914. It was 1,440 by January 1922. By December of 1923, it had risen to 1.26 quadrillion the price level had. So this is a massive increase. And like I mentioned earlier, the currency was virtually worthless. It took so much of any currency to purchase anything that they would take wheelbarrows full of the bills around, buy the first thing that they could after being paid, and then barter with other people just to try to do something. And the economy experienced a terrible, terrible depression as a result.